raise rates by half a percentage point. Joining us right now to look ahead is the Wall Street Journal's chief economics correspondent. He is the author of the must-read book, $1 Trillion Triage. Nick Timiraos is here. Nick, great to see you. Thanks very much for being here. Are we going to see a half point? And what are you expecting, importantly, Jay Powell to discuss in that Fed meeting, the final one of the year?
Well, thanks for having me, Maria. Yes, a half-point increase seems like a lock at the meeting that will end this afternoon. And the big question is, what does Jay Powell say in the press conference? What do Fed officials put down in their quarterly economic projections? How much higher do they see interest rates going next year? You know, the truth is that it seems as if we're closer to the end of this process now than the beginning, because the Fed has raised interest rates so much this year. And so markets are already looking ahead to when the Fed might cut. And I imagine what Powell wants to get across is this idea that just because the Fed is done raising interest rates in the first quarter or the second quarter of next year doesn't mean that cuts are right around the corner. The challenge, of course, is that nobody really knows what's going to happen in the economy. You look at the inflation numbers yesterday. It was a very good report. You've now had 2 good reports in a row. And so there are some people who are saying, well, maybe inflation was transitory after all. It just took a lot longer to get through this post-pandemic bulge in prices than people had anticipated a year ago.
But what about the macro story? I mean, what do you look at in terms of identifying how weak or where the growth is or how weak things will get on the macro picture? Because you've still got so many people out there expecting recession, right, in 23.
You do, but you also have another year of inflation ending, you know, pick whichever index you want to use. Let's call it 6%, same as last year. And the calendar here is important because whatever happens in December, that's what's going to get baked into wage negotiations next year. And so if you've had 2 years of 5 or 6% inflation, you're now going to have workers saying, well, I want 5 or 6% increase in my pay in order to catch up to what's been happening with prices. And if you have that continue for another year, that is the Fed's concern. That is Powell's concern, that what started as something that was not driven by the labor market will be sustained by higher wages. And so I imagine that's the debate right now around the boardroom table at the Federal Open Market Committee. You know, you have a group of people saying the declines in goods prices that we have been anticipating are here. We don't have to do anything else. We need to just see what we've done, let it take its course. And then you're going to have other people saying, well, wait a minute. You have higher wages. There's a concern that that's going to continue to feed through to higher prices, and so it's too soon to stop.
Nick, it's Dagan McDowell, particularly in the services sector, where wages make up the largest cost in delivering services, which I know that you have written about. Talk about also the market reaction. It's something that you discussed recently, one of the last times you were on Maria's show, and that's the exuberance in the market and how tight financial conditions are or how loose financial conditions are and how that might impact Jay Powell and the Federal Reserve's thinking today and in the meetings ahead.
The whole point of raising interest rates by 425 basis points this year, the most in a year since the early 1980s, has been, like you said, Dagan, to tighten financial conditions and to keep them tight. The Fed thinks that is how they are going to achieve getting control of inflation. You're slowing down the economy. You're slowing down investment and spending and hiring. And frankly, we haven't seen a lot of the slowdown yet. Every economist, a lot of economists are that I talk to are anticipating a recession next year. But we don't see it yet in the labor market numbers. We see strong wage growth. We see continued hiring, maybe not as strong as it was last year. And so that's the question here, is if you have another rally in the market, if you see stocks going up, if you see mortgage rates coming down, and some more activity in the housing market, which has really been, on the mat here for the last 6 months, then you begin to wonder, well, could you have a reacceleration in the first quarter, or will the lagged effect of all the Fed rate increases finally begin to catch up and really, you'll feel that in the economy. You'll see the slowdown in hiring. which the Fed probably wants to see because it will give them more confidence that they've actually gotten on top of the inflation in the services sector that you were talking about.
Nick, we haven't talked about the supply side of the economy yet. We got some horrible numbers on productivity in the U.S. over the last year. It seems to me the Fed can only do so much to destroy demand. You've got to have productivity come back. Do you see signs of that happening? Because to me, that's the piece that keeps us from getting back to the 2% that the Fed's targeting.
Yeah, you're absolutely right. And, the productivity numbers have not been good. But the quarterly numbers, they're a little bit of a mess. They're all, they're up, they're down. They've been very difficult to read on what's happened in the post-pandemic economy. There are a lot of economists and optimists, kind of technological optimists, who say, look at all of this work from home, virtual meetings that we've been able to do. That has to show up in improved productivity at some point. There are probably issues around, what we're capturing. A lot of the economic indicators we're built for an industrial economy. We have a primarily services economy. And what we've seen in the economy this year has been a rotation or a transition away from that industrial economy and into the services economy. So you're right. The Fed chair last month said wages need to slow down if productivity doesn't pick up. He even said, we were about 2 percentage points too high right now on wages. And so that's definitely going to be something that the Fed is looking at in the coming months and the year ahead.
Yeah, especially since inflation has become real persistent in services, as well as the good side of the economy. Nick, this was a great conversation. We so appreciate your time. Thank you so much.
Thank you very much.
All right, we'll see you soon. Nick Timiraos joining us from the Wall Street Journal.